It's so much to talk about, but I do want to start with those inventory numbers. Where are we in the U.S. in terms of draws and production?
Hey, Alex, thanks for having me. Look, I mean, production's been ticking up pretty quickly here. And interestingly enough, inventories have been falling for some time. In our view, going forward, we're going to see those inventory draws slow down meaningfully on a global basis, not just in the U.S. And what we're going to see is more OPEC supply, which I think will be ratified today, if you like. They'll increase the 400,000 barrels a day they've agreed to, and they'll continue to do so for a while. And we're also going to see a fair amount of U.S. supply. We think that next year there could be close to a 2 million barrel a day increase in global output, with the U.S. taking the lion's share of that oil. So we're going to see more supply and a slowdown in the demand growth pattern. So that should, I think, stabilize inventories here.
So, Francisco, on the U.S. part, I thought that producers were going to be super disciplined.
Well, that's true for both the listed names and the multinational oil companies, the oil majors. But it's not so true for the small producers, for the private companies, the mom and pops. They are indeed drilling a lot more. So we are seeing good growth, and there's always going to be the case of a rebound, but it's turning out to be a little stronger than we thought. And that's leading to a widening divide between Brent and WTI, which has been exacerbated by, of course, Ida. So.
Yeah, let's get to that. So we are seeing that spread really wide in there between, a shrink between WTI and Brent, as WTI is just a little heavier than Brent in terms of the price action. The other narrative in relation to Ida is that production is going to restart a lot faster than refiners are going to restart, because you wound up seeing the storm really hit a lot of the refiners on the U.S. Gulf Coast. How long does that last for, that spread?
I mean, I think the spread is going to be a little wide for about a month or so. Remember, we've lost about 1 million barrels a day of refining capacity in terms of outages because of the hurricane, and production seems to be coming back pretty quickly. And then you have all the pent-up growth that I just discussed. So if you look at the picture for Brent-WTI, to us it looks a little bearish, at least in the next month or so. Also, remember, on top of the production story and the refining story, there is the there's a global consumption growth story, which has continued to lift the product markets. So that I think also favors refiners to come back a little stronger. So again, in our view, maybe we're talking about a month or two of stronger Brent relative to WTI, but again, something that OPEC can fix quite quickly.
So then what does that do to gasoline stockpiles? Because on the one hand, that super strong driving season is going to come to an end. We've also seen higher gasoline prices, which could always get worse, and that might crimp some demand on driving. But on the flip side, oil inventories can't really replenish if refiners are going to take a while to restart. Where are we left here?
Well, I mean, I think where we're left is we need leadership, Alex. And in every market, you need something to be driving you up or driving you down. And as you rightly pointed out, we've had a phenomenal driving season in the U.S. and also to some extent in Europe as well. And things have come back. Now we need the middle distillate complex, the diesel, the gas oil, the heating oil, to lead the complex higher into the winter. And this is where the problem lies. We have a very strong trucking market. Of course, we are all trading goods and buying things from all over the world, so the market's strong. So there's a lot of demand for diesel. But jet fuel, which is part of that complex, is quite depressed, and I don't see that changing dramatically, with Europe recommending yesterday, I believe, or the day before, to stop travel of vaccinated, not vaccinated U.S. travelers. So the whole COVID situation, the Delta variant, will keep limiting, in our view, international travel for at least another 3 or 4 months. And that's going to be a drag into the winter season for the distillate complex, and hence oil and the broader petroleum markets.
On the flip side, then it looks like OPEC Plus is going to keep raising 400,000 barrels of oil a day, get back to full production in 2022. Deputy Prime Minister Alexander Novak, though, saying, hey, we could produce more if you wanted us to. Should they be adding more oil to the market right now?
Look, I mean, I think it depends what price they want to achieve, or what kind of price stability. I think, honestly, you probably don't need a lot more oil. Maybe a little more with this plan is fine. Our view is that Brent is going to be a range-bound market, call it 65 on the lows, 75 on the highs. and OPEC will try to keep it in that band, even though they don't really target prices, of course, as we know. But I think we've kind of gotten to the bottom end of inventories. You can draw inventories a little more, but it's going to be hard to keep drawing those inventories. And I think what OPEC's saying is we've drawn inventories quite a bit. Maybe it's time to stop the inventory draw within the next couple of months, and I think that's what we'll see. And that means a flatter oil curve. It means a more range-bound market until we get into the next driving season and things get more exciting again for oil. But it could be a little boring here for a bit.
Yeah, and OPEC Plus kind of says the same thing. They're like, okay, we see some deficits here this year, but then some supply builds in 2022. So let's get some prices on that. I spoke to Ed Morse over at Citi a couple days ago, Francisco, and I said, like, what's your conviction in your bullish oil call? And here's part of what he said.
I'm bullish for the next 3 months. I must say that next year is a challenge. It will be even more of a challenge if there is a JCPOA agreement and the U.S. and Iran return to it. Iran could bring 1.5 million, 1.8 million barrels a day back into the market. That is still a wild card. It's less probable right now than it seemed to be 3 months ago, but that's an awful lot of oil.
Do you agree, bullish for a few months and then reestablish?
I see more of a range-bound market for a bit here. I mean, I think like I said, there is no distillate leadership. We need jet fuel. We need the distillate complex to drive us higher, and I just don't quite see that in the next few months. What I do see next year is I see a strong driving season, even stronger than this year. So I don't think we'll see. And I'm worried about Iran, like everybody else is, but I do think OPEC will accommodate Iran. And look, I mean, if we do contain the Delta variant in the next few months, it'll be a very different story. I think the reopening of international travel, that's really what's going to trigger, I think, the next leg up in oil. And I don't see that in the next 3 months. I do see it next year, though. I think next year is a much higher likelihood once we all have our third booster shot. And we all get the jabs. I think it's going to be a lot easier to move around the world. So I'm more optimistic in 22.
From your lips, man. Let's put it that way. Francisco Blanch, always good to catch up with you. Bank of America Global Research, Head of Global Commodities and Derivatives Research. Always a pleasure. Thank you very much.